Average returns, how do we calculate the average returns on these instruments? Very simply, add up each year's return, R1, R2, R3, R94, divided by 94. So sum up those annual returns and divide by the number of observations to get the average. So it's very simple to do, and that's what Ibbotson and Sinkfeld have done for us. And here you can see performance over the last 94 years. Large company stocks will get you, on average, about 12%. So if you go out and invest in that, and history repeats itself, you'll average about 12% in large company stocks. Small company stocks will get you about 16 to 17%, somewhere in that ballpark. High risk, high return. Bonds will get you 6%. Whether it be corporate bonds or government bonds, you're going to get about 6% if history repeats itself again. T-bills, low risk, low return, 3 to 4%. Inflation has averaged about 3% over the past 93, 94 years. And we can calculate the real return using the Fisher effect by just simply subtracting inflation. So on the T-bills, they only give you a real return of about 0.5%. So they basically mimic inflation. They're very closely tied to inflation. We can look at types of stocks and sizes of companies. So value stocks are where Warren Buffett tends to play. He looks at large, well-established companies trading below the price that analysts think it's worth, and he'll try and find a value and watch that value go up. He invests in Coca-Cola, many insurance companies, and his own personal company, Berkshire Hathaway, tends to do very, very well over time using that strategy. Growth stocks are for those who want more significant growth and are willing to take on a little bit higher risk. So growth stocks anticipate to grow significantly above the market's average growth rate. We can look at large company stocks with a market valuation of over $10 billion, medium cap stocks worth $2 billion to $10 billion, and small cap stocks worth $300 million to $2 billion in capitalization. And we calculate those numbers by taking the number of shares outstanding times the stock price on the day of interest. Value stocks generally perform better during bear markets. Growth stocks generally perform better during bull markets. We can also calculate the risk premium. What is the excess return I demand from an investment if I buy a risky asset above that risk-free investment known as the T-bill rate? T-bill rates, virtually risk-free, virtually free. Generally, they're short-term, but you can buy some long-term T-bills also. But the short-term T-bills are virtually risk-free of default risk over their short lives, and we call that the risk-free rate. So to calculate the risk premium, we simply take the average return of any of those investments minus the T-bill rate. So it's a very simple calculation. How much do I demand if I am going to invest in small company stocks? Well, I have to subtract the total return, average return 16.3%, minus the T-bill rate of 3.4%. And so I demand a risk premium of almost 13% if I convince me to invest in those small company stocks. Obviously, bonds are only a few points above the T-bill rate or risk-free rate, so they're much less risky in general.